If you've been following the Toronto real estate market, you'll know that buying competition is pretty fierce. When you combine strong demand with a slow January for supply because of lockdowns and crazy snowstorms, it was pretty tough for buyers in January. And so last month saw the second biggest increase in prices on record. Right now, we're happy to announce that supply is coming back, and so the market is becoming more balanced, and we're not all competing for the same handful of properties anymore. Real estate is still very hot, and there are many investors with a lot of cash to deploy still. And when you're looking to find the best investments out there, you will most likely be looking at real estate because it's one of the more stable and better performing investments out there right now. Now, we all know interest rates are due to rise, and traditionally, you might have been taught that as interest rates go up and take mortgage payments higher, you would see a slowdown in demand for real estate. But let me tell you, that's a simplified answer, and I don't 100% agree with that, especially in the Toronto market. So in this video, let's dive into this and see how real estate in Toronto is really affected once interest rates start to go up. If you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you see more videos like this made specifically for real estate investors in Toronto. Rising interest rates will slow real estate demand. I'd say this statement is probably more true for end user real estate markets. What's happened over the past 2 years is that home prices, especially in the suburban end user pockets, have skyrocketed, but expenses have still been manageable because of rock bottom interest rates. Let's say someone could afford a $1.2 million home on a 3% interest rate, paying a $4,000 monthly mortgage payment. When rates drop to 1.5%, with a $4,000 monthly mortgage, they can now afford a $1.45 million home, which is why prices are able to go up more quickly when rates drop. Now, we're expecting rates to go up by 1% by year end. Even if we adjust for higher income because of rising inflation, let's say the budget is now $4,500 per month for your mortgage payments, at a higher interest rate, this still means $1.45 million isn't affordable anymore, and now the budget has come down to $1.4 million. This is the reason end-user home prices can't go up as quickly once interest rates start to rise. But in my mind, I feel that this isn't the case for investment properties in Toronto. We know that interest rates are rising because of inflation. And as inflation comes up, the upside for real estate investments is that rents also tend to come up. Rents in Toronto are expected to rise 11% by the end of the year, according to rentals.ca. So if interest rates go up by 1% and rents go up by 11%, the net effect is that cash flows don't really change all that much at all. Stable holding power means there's less friction to slow down real estate growth. Now, that was my thinking, but I wanted to validate it, so I went back to see how Toronto real estate reacted as interest rates changed over time, and the results are super interesting. In my simplified analysis, I split the data into 3 segments: Toronto detached homes, Toronto semis, and Toronto condos. Detached homes in Toronto are the most expensive, and these homes are typically owned by end users rather than investors. Semis are cheaper and attract a better balance of end users and investors. Just so you know, semis attract a bigger relative investor pool because the entry price is cheaper, and rent yields also tend to be better than condos and better than detached homes. What we find is that for the same sized home in the same neighborhood with similar rents, semis tend to be cheaper to buy than a detached home. So what you end up with is that your rent yields are better, which is better from an investment holding power and return standpoint. Finally, we have our condos, and we know these are very popular with investors because they are the easiest piece of Toronto real estate to get into. They have the lowest purchase price, and they generally make a more passive investment. So here's a chart that I made that compares real estate price growth for each of those 3 property types stacked against Canada's interest rate movements. As you can see, when rates are lower, freeholds perform the best. Again, just to recap, When there are more end-user type homes like detached properties, lower monthly payments mean better buying power, just like what we talked about before, so these homes tend to shoot up more quickly. We also see that semis do just as well as detached homes, even when they have more investors in the mix. On the other hand, condos, which have a major chunk of investors, do not do as well. So let's try to make sense of all of this, and the big difference here is that the cash flow position plays a big role for investment properties when our economy is in a downturn. When things turn south, consumer goods and services tend to drop in price, and this affects rents as well. What we also notice is that luxury goods and services tend to drop more during these times, which is why condo rents usually see bigger drops. Based on the last downturn, interest rates dropped to 1.5% and condo rents came down by around 20%. So the net effect is that cash flows actually got worse for the condo investor, which is why there's less room for condo prices to come up. But if this is happening to condos, how come it didn't seem to have as much of an impact for semis, which also have a big investor pool? Well, semis are different from condos because their cash flows are different. To begin with, we're looking at stronger positive cash flows instead of negative cash flows. Then, freehold rentals are less luxurious, I would say, so rents don't actually get as affected in a downturn. Instead of dropping 20% like condos in the last 2 years, freehold rentals dropped close to 10% in rents. When you combine a smaller drop in rents with improved mortgage rates, the cash flow situation for semis actually look better when rates drop. This gives more room for freehold investments to go up in price. Now, if we look back to history, once rates start coming up, you'll see that our end user type properties, the detached homes, start slowing down in growth as expected. At this point, condos start catching up, but perhaps the more interesting thing is that semis continue to do very well. When interest rates go up, in theory, the reverse will start happening. But on top of that, rents typically recover more than the previous pullback because more time has passed. And so you end up seeing improved cash flows for all real estate investments, which is why prices can go up more quickly than before. When it comes down to investing, we're still seeing investors with a lot of cash to invest in. And so if money isn't as big of an issue, investors will typically go with the strongest and best performing investments. And as we know, freeholds will be the top choice since they have better holding power and better overall returns. Just to clarify, I did use semis as our freehold investments and detached homes as our end user case, and it's really just to simplify my analysis. Now, this doesn't mean detached homes necessarily make bad freehold investments, and if I were to generalize it even more, I'd also put detached homes in investment pockets in the same outperform category as semis in Toronto too. I hope this video helped you clear things up, and yes, you'd likely see the best long-term growth in freehold investment properties in Toronto because their returns stay strong no matter if rates go up or down. Now, if you're limited by budget, condos are also a good buy right now. If we go back to our chart, it is possible to see a temporary dip in all markets when rates start to go up, but it's pretty quick and pretty hard to catch. And if you miss that boat, prices on semis and condos are likely to resume their upward trend pretty quickly. In Toronto, experts are expecting a pretty quick 11% rent increase by year end and a 12% price growth by year end. So this makes investing in real estate right now a pretty good idea. With more supply coming onto the market, there's more to choose from, and we know where the best deals are. If you're looking for help to grow your real estate portfolio, we're ready for you. Let's connect and let us know what your budget and preferences are, and then based on your requirements, we'll guide you through the best investment property search and buying experience in Toronto and find you that perfect property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up And look for us on Facebook, Instagram, or LinkedIn to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.